Hi everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. This time we're diving into a 10Q report from Harvard Diversified, and let me tell you, this one's a bit of a bumpy ride. It's like watching a sitcom where the main character keeps making the wrong choices. But hey, at least it's entertaining in a morbid sort of way. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can talk with other folks about today's topic. Or I'll start. First off, a quick word about forward-looking statements. Remember, anything the company says about the future is basically just a guess. Actual results could be way different and probably will be. It's like when your friend says they'll be ready in 5 minutes, but they're still in their pajamas an hour later. Now, before we even get to the numbers, there's a bit of a red flag. It seems Harvard had to restate some previous financial statements. Translation, they had to go back and fix some mistakes in earlier reports. Anytime you see a restatement, it's a good idea to proceed with caution. It means that something was not correct before. Okay, let's get to the financial numbers. As of September, Harvard's cash and cash equivalents were roughly 6.7 million, way down from almost 21 million at the end of last year. That's like having a leaky piggy bank. But hey, their marketable securities, the investments they can quickly turn into cash, are up a bit, almost 98 million. It seems they are shifting the money into liquid stock market assets. Take a look at their property and equipment. They own a lot of flight equipment, around 260 million worth. But here's the kicker. Almost 214 million has been depreciated, meaning it has lost value over time. That means these assets are getting old and wearing out. It's like having a classic car that needs constant repairs. Let's look at the income statement for the 3 months ended in September. Their operating revenues, what they make from their core business, were around 53 million. That means they lost money just keeping the lights on. Check this out, aircraft fuel costs. For the most recent quarter, they spent just 76,000 compared to 115,000 last year, meaning they are flying less planes. For the 3 months, they had a net loss of 2.2 million. Luckily, it's better than last year's 4.5 million, but still not great. It's like losing weight, but only a tiny bit. Looking at the 9-month picture for the year so far, their total operating revenue is around 144 million, but expenses are 170 million. Aircraft maintenance costs are down almost 5 million. It might sound good on paper, but it could be because their planes are not being used and are sitting parked, or because they are foregoing maintenance. Net loss available to common stockholders is 20 million, also an improvement compared to 21.9 million, but it's not an amazing turnaround. Now for the statement of cash flows. This tells us where the company's cash is going and coming from. In the 9 months, there was a huge cash decrease, almost 14 million, meaning their cash pile is depleting. Interestingly, although the company didn't generate a lot of cash on its own, it spent money buying securities, spending 2 million on that. They spent around 10 million buying back stock. A company that buys back shares often thinks their stock is cheap or want to make it look cheaper. Also, dividends of almost 1 million. Now let's get into the juicy details, the footnotes. This is where companies have to be extra honest. The company had principal lines of business focused on regional air services, flight equipment leasing, and equipment financing. But now they only have lessors because they announced that American is dropping them. A major revenue concentration risk. Almost all the company's operating revenues were tied to the capacity purchase agreement with American. The company is in debt of a couple of million. They got it by issuing bonds. This is their ability to meet short-term obligations and bills. The company is worried that without the American deal in place, it may not be able to pay its bills in the future. They have more concerns as well. It seems that a dispute with United resulted in them being unable to obtain payments and forced them to restate their financials. Any financial restatement is a giant red flag. Because of the American deal coming to an end, Air Wisconsin is exploring new business ventures such as charter operations, essential air service markets, and code share agreements. However, these efforts have not yet led to positive results. They are now exploring alternative strategies. They also have state tax receivables, and the company management is deciding if they will be repaid or not. The company also has some commitments and contingencies that may impact them in the future. Specifically, they are waiting on a government audit. And what do you know? They are paying retention bonuses to some executives. Okay, let's talk about risks. A lot of this is copy-pasted, but we have to go through some key bits. First is about the airline industry being impacted by numerous factors beyond Air Wisconsin's control. As of right now, they only operate one aircraft type, which makes them vulnerable to regulations. They note the problems about an aging air fleet. A notable risks for those interested in their business. They don't know if they will get as much money from any deals in the future. Also of note is most of Air Wisconsin's workforce is represented by labor unions, which could impact their plans. What's the story here? Harbour Diversified is in a tough spot. Their main revenue source is drying up. Their planes are getting old, and they're trying to pivot to new business areas without any guaranteed success. The restatement, the pilot shortage, they all add up to a lot of uncertainty. This is a company at a crossroads, and whether it goes up or down is a coin flip. The financial numbers are pretty clear. Revenues are down and they are bleeding cash. They're definitely trying to stay afloat. The new business opportunities they are trying to pursue could help diversify their income. The big question is if these efforts are realistic. What do you think will happen with Harbour? Will they be able to navigate this crisis? Leave your thoughts in the comments. If you found this breakdown useful, hit the like button and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord channel in the description below for more discussion and insights. Thanks for tuning in. See you next time.